In this video, we describe the accounting for investments in debt security. Firms have different motivations for investing in debt securities. Primarily, it's to earn a higher rate of return, and then also often to secure operating or financing arrangements with another company. For instance, Boeing will extend financing to suppliers as well as customers. Automobile companies have often also been quick to extend financing to suppliers, particularly when they're in financial distress, and if the supplier provides critical components. Companies will account for investments in debt and marketable securities based on the type, whether they're debt or equity, as well as their intent with respect to the investment. That is, do they plan to hold on to the security? Do they plan to sell it right away? We have three broad types. There are debt securities in which the management has no intent or plan to sell, and those will typically value at amortized cost or fair value, we'll see. Again, that depends on management's intent. And then we also have equity securities, and we can buy equity securities with the intention to sell, hold on them, and exercise some control of another company, or acquire more than 50%, that is voting control, in which case we will consolidate that from an accounting perspective. So we see both the type of security as well as management's intent impact our accounting and valuation. We're going to take a little bit more of a look at some of the debt classifications of debt investments, which are also referred to as marketable securities, and they represent a creditor relationship. Some of the broad types would be investments in U.S. government securities, municipal bonds, convertible bonds, corporate debt, or commercial paper. And we will account for those either as held to maturity, trading, or available for sale. We'll see that companies have the option to record fair values for most financial assets, as well as, you recall in Chapter 14, financial liabilities. The FASB believes that fair value measurement for financial instruments provides more relevant and understandable information than amortized cost. Recall, we often want information is both reliable and relevant, and the reliable is one of the reasons we've relied on historical cost for a lot of assets. But financial assets with readily determined marketable values, the fair values are both reliable and relevant, so they check off two boxes of desirable characteristics for valuing and accounting for an asset. When we think about valuing marketable securities, a variety of factors will affect the market value of debt investments. And two particular important factors are, one, the change in credit risk of the company whose debt we're holding. If their credit risk deteriorates, as in the case of the current pandemic, the value of those marketable securities can decline significantly. And then the second one, and more frequent, is the changes in interest rates. And of course, those changes in interest rates can be due to one of two things: changes in the underlying credit risk of the company whose financial instrument we hold, or changes in overall market interest rates, which are much more related to changes in the business cycle, inflation, and other broad economic impacts. But the important thing to remember, when we do have changes in interest rates, rising interest rates will mean lower present values. So interest rates rise, bond prices, debt investments lose value. And then falling interest rates mean debt investments increase in value because present values of future cash flows increase. So changes in interest rates significantly impact the market value of debt investments. We're going to go ahead and take a look at the classification and ways we value different types of debt investments. The first one we'll consider are trading securities, which are debt securities bought and held primarily for sale in the near term to generate income or profits based on short-term price differences. So we've bought them with the intent to flip them. The second broad classification are what we refer to as available for sale. These are securities we didn't buy with the intent of flipping right away, but nor do we necessarily intend to hold them until maturity, which of course brings us to our final portfolio classification, which is hold to maturity. These are investments we've made in which we have both the ability and intent to hold them until they mature. In other words, we'll collect the full face value or par value. That's important to keep in mind as we discuss the valuations and accounting for these various types of securities. Let's go ahead and take a look at trading. Now, trading securities can be either debt or equity. We're going to be focusing on debt securities. But in any event, both debt and equity securities that we bought with the intention of trading will be valued at their fair value and they're classified as current assets. Available for sale securities can also be debt or equity, and again, we value them using fair values, and they can be classified as either current or non-current. Then finally, we have hold to maturity. And the hold to maturity securities can only be debt securities, not common stock, because equity doesn't have a maturity. So only debt can be held until it's matured. And again, we have to have both the positive ability and intent to hold them to maturity. And if we do, we will account for them at their amortized cost. In other words, historical cost plus or minus any amortized premiums or discounts. And the classification, again, could be current or non-current, depending on how soon or how long till they mature. Let's take a look at the idea or concepts behind these various classifications and their impact on the financial statement. We'll begin by considering our basic accounting equation. We've got assets equal liabilities plus equity, and we've got revenues minus expenses equaling net income. And of course, our balance sheet has to balance, and our income statement ties to our balance sheet through retained earnings and equity. Let's consider first the implications of valuing trading securities at their fair market value. In other words, at the end of each financial period or reporting period, we either report increases in asset values or decreases in asset values. And of course, an increase in an asset value would have to be accompanied by an unrealized gain, and a loss in value would be accompanied by an unrealized loss. And again, unrealized just means we haven't sold the security yet. Or once we sell the asset, then we have a realized gain or realized loss. So think about the volatility of the stock market. Assets are always going up and down in value. Those unrealized gains and losses can cause a great deal of distortion on our income statement or bottom line net income that wouldn't be there absent that fair value valuation. So fair value valuation will give us a little bit better balance sheet, but it introduces a great deal of noise in our income statement. We can see that looking at a one-year stock chart of the S&P 500 index. It's pretty much all over the place. And all of those ups and downs, of course, result in gains and losses, which flow through directly to our income statement and create a lot of uncertainty regarding the interpretation of that bottom line net income figure. So it reduces the usefulness of the income statement to predict future earnings. Well, if you're a strong advocate of the income statement and you think it's very important for companies to be able to, or investors to be able to use that net income figure to predict future earnings, then you might prefer a hold to maturity approach in which assets are recorded at their historical cost, and of course we amortize any premiums or discounts, but we ignore changes in fair market value from period to period. So there's no flow directly to the income statement. So we think about it. The trading securities, that gives us a very good picture of the value of our underlying assets on our balance sheet, but can distort earnings with unrealized gains and losses. Where on the other hand, our hold to maturity approach doesn't introduce any unwanted noise or distortions to the income statement, but it has that failure of not being particularly accurate valuation on our balance sheet. We're sticking with historical cost rather than current market values. Well, is there a compromise? Well, I don't know if I'd call it a compromise, but there is a middle ground, and that's the securities we classify as available for sale. We will record increases and decreases in the value of our assets on our balance sheet. But rather than recording unrealized gains and losses directly on our income statement, we record unrealized gains and losses as part of other comprehensive income directly in the equity section of our balance sheet. So we bypass that above the line net income figure. And so let's recap. Again, trading securities. And these are these are primarily held by financial institutions, but businesses whose business is to try to profit off of changes, short-term swings in the prices of assets. Well, if that is indeed their business and part of their current operations, well, then we probably should flow those items through our income statement. But if you've purchased investments and they're not necessarily trading, but you aren't going to hold them to maturity, and again, the argument of holding to maturity and not recording gains and losses is at maturity, we know we're going to get the par value. We know what it's going to be worth. So in the interim, why would we record all these increases and decreases, these unrealized gains and losses? And then, of course, the available for sale. Again, we don't necessarily intend to hold it to maturity, but we didn't buy it to trade. We will record it at fair values, but those unrealized gains and losses don't become part of the income statement. We park them in other comprehensive income in the equity section of our balance sheet. Let's take a look at that now. Here's a typical income statement: operating profit, other revenues and expenses, and net income. Then, if we have those unrealized gains and losses on securities that we've classified as available for sale, we stick them in other comprehensive income along with translation gains and losses on foreign currency and some other items, and we report them directly in the stockholders' equity section. So there we have it. We have common stock, retained earnings, and other accumulated comprehensive income. In this case, we have unrealized gains because we can see it was an increase in overall equity. If we had accumulated unrealized losses as part of other comprehensive income, stockholders' equity would decrease. And a broader view of it might be just like this. We have a beginning balance, current period, unrealized gains, and then an ending balance in other comprehensive income. So to summarize, again, trading securities valued at fair value, unrealized holding gains and losses become part of net income. And of course, if we earn any interest or if we have regular gains and losses from the actual sales, we report those on our income statement as well. Then we had at that other extreme, the hold to maturity. We have the ability and intent to hold it till the bonds mature. And this again only refers to debt securities. Amortized cost. Gains and losses, unrealized, they aren't recognized on our income statement. And again, if we earn interest income or we have gains or losses from actual sales, we will record that directly on the income statement. And then finally, the one that fit right between were securities that were available for sale. We aren't holding them to maturity, nor did we buy them to profit from short-term price movements. We again record those at fair value, but this is the important part. Unrealized gains or losses become part of other comprehensive income, a separate part of stockholders' equity. And like the others, we record interest when earned and gains and losses from actual sales.